Nobody tells you this, but here's something that's going to mess with your head about how the ultra wealthy actually manage their money. What if I told you that families like the Rockefellers, we're talking about generational wealth that's lasted over a century, don't put the majority of their assets into stocks, crypto, or flashy investments? Instead, they put most of their money into something so boring that when I tell people what it is, they usually think I'm joking. But here's the crazy part. This boring system has never lost money during any recession or market crash in over 150 years. But when I dug deeper, I found out that major banks, Fortune 500 companies, and even the Federal Reserve use this exact same system for their own money. It's been around over 150 years, it's never lost money during any recession or market crash, and it does something that literally no other investment can do. Today, I'm going to show you exactly what this boring system is and why the people who really understand money refuse to put their wealth anywhere else. Alright, so what is this boring system? It's whole life insurance, but not the way most people think about it. Most people, when they hear life insurance, they think death benefit, monthly premiums, something you buy and forget about. But that's not what we're talking about here. We're talking about using whole life insurance as a wealth building machine. Here's how it actually works. A whole life insurance policy has three main components. First, you've got your premium payments. That's the money you put in. Second, there's the death benefit. That's the insurance part everyone knows about. But third, and this is where it gets interesting, you've got cash value that builds up inside the policy. Now, here's the key difference. With whole life insurance, your cash value is guaranteed to grow every single year. It doesn't matter if the stock market crashes, if there's a recession, if crypto goes to zero, your money inside this policy keeps growing. We're talking about guaranteed growth of about 4 to 5% annually, and that's after all fees and costs. Let's think about it like equity in real estate. Let's say you own a multi-million-dollar property that appreciates 5% per year. That property is now worth $1,050,000 after year one, right? Now, if you take out a $500,000 loan against that property, does the property stop appreciating? Of course not. It still grows on the full $1,000,000 value, even though you borrowed against it. Whole life insurance works exactly the same way. Your cash value grows on the full amount, whether you borrow against it or not. But here's where it gets even better. When you borrow from your policy, there's no credit checks, no monthly payments, and you can access the money in days, not weeks. Most people think they're just buying insurance, but that's missing the real power. The death benefit is actually just your permission slip to use this system. What you're really building is your own personal bank account that grows tax-free and gives you complete control over your money. Now, why can insurance companies consistently pay these returns? It comes down to how they invest. Mutual insurance companies, and these are the only ones you want to work with, are owned by the policy holders. When the company makes a profit, they distribute those profits back to policyholders as dividends. These companies invest very conservatively. They put their money into bonds, commercial real estate, mortgage notes, and sometimes they'll acquire other businesses, but they're not gambling in the stock market. They're making safe, predictable investments that guarantee steady returns year after year. The other thing insurance companies are really good at is predicting mortality. They know statistically when people are going to die, so they can calculate exactly how long you'll hold your premiums and earn returns on that money. This lets them guarantee your growth while still making a profit. What you end up with is a completely safe, predictable wealth building vehicle that grows regardless of what's happening in the economy. No market risk, no interest rate risk, no credit risk, just steady guaranteed growth that compounds over time. Now, here's where this gets really powerful. How wealthy people actually use this system, they're not just letting money sit there growing at 4 or 5%. They're using what's called a policy loan strategy to multiply their returns and create infinite banking. Now, let's say you've got $1,000,000 of cash value in your policy and it's earning 5% per year. That's $50,000 in growth. Now, you see a real estate deal that's going to return 10%, but you need $500,000 to buy it. Instead of going to a bank, you borrow $500,000 from your own policy at 5% interest. Here's the beautiful part. Your cash value keeps earning 5% on the full million, even though you borrowed half of it. So you're still getting $50,000 growth from the policy. You're paying $25,000 in interest to the insurance company on the loan, but now you're earning $50,000 from the real estate investment. Your total return, $75,000 instead of just the $50,000 you would have made leaving the money alone. This is what I mean by infinite banking. You become your own bank instead of making other banks rich. When you need money for an opportunity, you don't just go hat in hand to some loan officer who's going to run your credit and make you jump through hoops. You call your insurance company, request a loan, and the money hits your account in a few days. The wealthy use this for everything: real estate deals, business opportunities, equipment purchases, even personal expenses. There's no monthly payment requirements, no amortization schedule. You can pay back the loan on your terms, or honestly, you don't have to pay it back at all. If you die with an outstanding loan, they just subtract from the death benefit. Here's another way the wealthy use this system that most people never think about. The death benefit acts like a permission slip to spend your other assets in retirement. Let's say you retire with $1 million nest egg. If you don't have life insurance, you're probably going to be conservative with that money because you want to leave something behind to your kids. But if you have $1 million life insurance policy, you can spend that nest egg freely, so you know your kids are still going to get $1 million tax-free when you die. This lets you enjoy retirement instead of hoarding money you're afraid to touch. You can also use the cash value itself for retirement income. Instead of taking withdrawals that are taxable, you take loans from your cash value. As long as you don't borrow more than what you've paid in premiums, those loans are completely tax-free. We're talking about creating a tax-free retirement income stream that you completely control. The interest cost on these loans isn't really a cost when you understand how the system works. You're paying interest to yourself, essentially. That interest goes back to the insurance company, which is owned by the policy holders. So it comes back to you in the form of higher dividends. It's a closed loop system. This is exactly what banks do with their money. By the way, banks are some of the largest purchasers of whole life insurance because they understand how this works. They're not putting their money in the stock market. They're using the same boring system they're trying to talk you out of. Now, here's where most people mess this up completely. And it's the difference between the system working like magic or becoming a total disaster. It all comes down to how the policy is structured, and most insurance agents will structure it wrong because they want maximum commission. When you pay money into a life insurance policy, that money can go two places. It can go to the base premium, which buys insurance coverage, or it can go to what's called paid up additions, which is basically a cash dump that immediately becomes cash value. Here's the problem. If you put all your money towards base premium, you get almost no cash value in the first few years. I've seen policies where someone puts in $100,000 the first year and gets zero cash value. Zero. All that money went to buying insurance and paying the agent's commission. The right way to structure this is to minimize the base premium and maximize the paid up additions. I want to see at least 60% of your money going to paid up additions, ideally closer to 80%. This means your first year cash value should be 80% of what you put in, not zero. Your break-even point should be somewhere in between year 3 and year 5. If an agent tells you that it's going to take 10 years to break even, run away. That policy is structured for their benefit, not yours. The agent makes way more commission on the base premium than the paid up additions, so they're incentivized to structure it wrong. When you ask for high cash value, they'll tell you that the policy will mech or that it can't be done. Don't accept that. Get a second opinion. Look, wealth isn't built through exciting investments that keep you up at night. It's built through boring, predictable systems that work the same year after year. This is exactly what banks and corporations use for their own money, and there's a reason for that. If you want to research this further, look for agents who can understand infinite banking and can structure policies for maximum cash value, not maximum commission. The rich have been using this boring system for generations because it works.